Over the last few months, a very specific narrative has taken hold on Wall Street. Investors and analysts alike have started claiming that Micron Technology has secured its place as the next NVIDIA of the artificial intelligence boom. Then, reality hit. Micron released a highly anticipated earnings report showing massive, explosive revenue growth. The stock briefly spiked to an all-time high, and the very next day, shares dropped over 8% in a massive sell-off. This chart shows the projected gross margins for both companies side by side. Micron is forecasting an 81% gross margin for its upcoming quarter. That actually exceeds NVIDIA's margins from 2023. They are printing money at historic rates, and investors still ran for the exits. This aggressive whiplash forces a critical question. We need to figure out if Micron has actually secured a permanent AI monopoly, or if they are simply a traditional manufacturer riding a temporary wave. Part of that sudden drop came from broad macroeconomic fears. Tensions in the Middle East flared, the Strait of Hormuz faced closures, and oil prices spiked. Capital immediately fled high-growth tech stocks for safer defensive assets. But the hardware market also got spooked by a highly specific technological threat. Google recently introduced a new quantitative algorithm called TurboQuant. The developers behind TurboQuant claim it can increase the speed of AI cache memory by several orders of magnitude. The market did the math and panicked. If you make memory processing drastically more efficient, AI developers will naturally buy fewer physical memory chips. To know if this algorithm will actually gut Micron's revenue, we have to look backward and examine a highly counterintuitive historical paradox about how humans consume efficient technology. Does making a technology highly efficient actually destroy the demand for it? Economists call the answer to this question the Jevons paradox. In the 19th century, the Scottish inventor James Watt engineered a highly efficient steam engine. His design drastically reduced the amount of coal required to produce a single unit of energy. The public assumed coal mining would slow down. The exact opposite happened. Because energy became incredibly cheap and accessible, factories expanded. Total overall coal consumption exploded. Apply that exact paradox to AI data centers today. TurboQuant's efficiency won't cause cloud giants to cancel their chip orders. It makes running artificial intelligence much cheaper, which will trigger massive companies to scale up their hardware infrastructure even faster. External demand from the tech industry is bulletproof right now. The real danger to Micron stock doesn't come from algorithms. It comes from the physical reality inside their own factories. Software companies and chip designers can pivot instantly. Micron cannot. They manufacture physical memory chips, an industry entirely bound to the cyclical boom and bust demand of physical end markets like personal computers and smartphones. Building a memory foundry requires years of architectural planning, billions in upfront capital, and massive inflexible fixed costs. They cannot spin up new supply overnight. This stacked chart breaks down Micron's earnings. While premium AI chips sit at the top, most margin expansion comes from the bottom block, cheap, older DDR4 chips. Aggressively shifting production to chase the AI boom accidentally triggered a severe shortage of those older legacy chips. Micron is generating historic profits right now by selling standard, low-cost memory at massive markups because of a physical bottleneck they helped create. In previous decades, memory manufacturers would see this kind of rabid demand and immediately panic-build new factories. That flooded the market with supply, crashed the price of chips, and wiped out their margins. This time, the big three memory manufacturers are executing a highly disciplined strategy. They are deliberately restricting new supply to keep prices artificially high. Samsung has fully committed to this slow-roll expansion, keeping new capacity tightly constrained. SK Hynix completes the trio. Together, these companies are artificially holding back physical output despite endless orders from the tech sector. By refusing to overbuild, they are perfectly orchestrating a prolonged, highly profitable peak, ensuring the market doesn't instantly collapse under a flood of new chips. The immediate financial reality is hard to ignore. Micron is trading at a forward price-to-earnings ratio of roughly 6, and they are on track to earn nearly $60 per share over the next 4 quarters. In the short term, as geopolitical fears cool off and their carefully managed capacity comes online, the stock is heavily positioned to outperform the broader market. But hardware is physical, and physical goods follow cycles. artificial intelligence has not cured the boom and bust nature of the memory market. It is simply the newest, heaviest wave. Eventually, the cloud giants will finish building their massive data centers. Competitors will enter the space, the technology will commoditize, and the price of memory chips will inevitably fall. Micron is a brilliantly executed cyclical play. It is incredibly lucrative to ride the way up, provided you recognize that gravity always wins in the end.